Hey, it's John AG, and I need you to hear this before the next candle prints because the moment silver stops being a chart and starts being a shortage, the rules change, the players change, and the people who waited for a pullback get left behind. Right now, silver isn't flirting with triple digits. It's trying to kick the door in. And if you've been watching this market for years, you already know the weird part. The move usually looks impossible right before it looks obvious. And look, quick favor before we go any further. I'm running a campaign to eliminate copycat channels that steal the work and confuse viewers. If you value what we do here, hit subscribe and comment our John AG so the algorithm knows who the real community is. Now, here's the wild part. While most people are still arguing about whether $100 is real, the market has already shown it can trade above that line and keep buyers coming back. Silver pushed into triple digits this week and the headlines finally noticed. But the real story is what's happening underneath the headlines. Because this isn't just a price event, it's a pressure event. And pressure doesn't politely ask permission before it releases. So, let me set the scene exactly the way I'm seeing it. Today is Saturday, January 24th, 2026, and the exact time in New York right now is 8:50 p.m. Drop a comment telling me what time you're watching this, because I want to see how global this moment really is. Now, if you're new here, I'm going to be blunt. Silver is not a cute little trade you try to flip for lunch money. Silver is a strategic asset, and it's one of the only assets on Earth that gets demanded in factories and demanded in fear at the same time. That dual identity is exactly why the moves get violent. But before we get into the mechanics, check the description after this video. I've put bonus links down there, including a premium WhatsApp channel link and a channel membership join link, so you can plug into updates and deeper breakdowns without chasing clips all over the internet. All right, now let's talk about what everyone is thinking, but most people won't say out loud. If silver can touch $100, why can't it live there? And if it can live there, what happens to everything priced in dollars when a metal with a billion-ounce supply starts behaving like it's scarce? Here's the first cliffhanger. The loudest voices telling you this is a blow-off top are often the same voices that ignored the setup for years, and when they finally show up, they don't show up to help you. They show up to manage your emotions. You've seen it before. They parade out the same playbook. Too far, too fast, retail mania, overbought, it's due to crash. And sure, could we get pullbacks? Of course, this is silver. It doesn't glide, it bites. But here's the difference between a pullback in a normal market and a pullback in a stressed market. In a stressed market, dips are not relief. They're invitations. And that's why I want to focus on the parts of the story that don't fit into a 2-sentence headline. Let's start with supply. People talk about annual production like it's a faucet you can turn up. It's not. Silver supply is messy. It's mined as a byproduct. It's refined through bottlenecks. And a chunk of what's needed every year comes from recycling. In fact, recycling is only around a fifth of annual supply in many estimates. And when demand spikes, recycling can't magically sprint because refining capacity is still refining capacity. So when you get a demand shock, the market doesn't respond like a supermarket. It responds like a traffic jam. Now let's talk demand. Industrial demand for silver has been setting records. And it's not because people suddenly fell in love with silver jewelry. It's because the modern world is wired, electrified, and increasingly hungry for components that need silver's conductivity. Silver industrial demand hit a record 680.5 million ounces in 2024, marking the fourth consecutive record year. That matters because industrial demand doesn't care about your technical indicators. A factory doesn't say RSI is high, let's wait. A supply chain manager says, do we have metal? Yes or no? And here's the second cliffhanger. When investment demand and industrial demand overlap, the market doesn't just re-prick, it can gap into a new reality. Now I know what some of you are thinking. Okay, John, but isn't this just another hype cycle? That's a fair question. And it's why I'm going to challenge one popular narrative right now. The idea that silver inevitably must race to some perfect historical ratio like 1:1 with gold as a guaranteed outcome. Could the gold-silver ratio compress dramatically? Absolutely. But must is a dangerous word in markets. The ratio isn't a law of physics. It's an outcome of competing forces, investment flows, industrial usage, mine supply, recycling, substitution, and yes, policy. Historically, the ratio has swung all over the place. Across the 20th century, the average has been around the high 40s to 1, and in the modern era, it has often lived much higher, sometimes pushing extreme readings. So here's the skeptic's angle. If silver goes parabolic, you will see countermoves. You'll see recycling ramp as price incentives explode. You'll see industrial users attempt thrifting and substitution where possible. You'll see margin hikes. You'll see volatility designed to shake weak hands. That doesn't kill the bull case. It just reminds you this is a war, not a cruise. And speaking of war, let's talk about the battlefield most people ignore. Inventories. When paper silver trades, it's easy to pretend physical doesn't matter. But physical always matters at the edge. Recent reporting has pointed to COMEX silver inventories falling toward the low 400 million ounce range. And that's not a trivial number when you consider how much of that is eligible versus registered and how quickly sentiment can flip when delivery pressure builds. In other words, the warehouse numbers are not just numbers, they're confidence meters. Now, when you combine constrained supply, record industrial pull, and investors waking up late, you get the kind of market that behaves like a spring being compressed. And this is where we talk about the $100 line itself. Psychological numbers are funny. They matter because humans think they matter. And because they matter, traders build traps around them. You get the first tag above, then the slam down, then the chop, then the C, it failed. And then when everyone is exhausted, price pushes through again, and suddenly the level that was resistance becomes a floor. That retest phase is not boring. It's the market checking who actually has conviction. So, if you're asking me, would you buy at $100? I'm going to answer it in a way that annoys short-term minds. The question is less about the number and more about the time horizon. If you're trying to scalp $10, this market will humble you. But if you're building a position because you believe currency purchasing power is being diluted and you want exposure to an asset that has both monetary and industrial gravity, then your focus isn't today's print. It's the trend of the decade. Here's a reality people don't like. Fiat systems survive until they don't, and the decline is slow until it becomes fast. And this is where I need to inject context that wasn't in the competitor's script because the why matters. In the early weeks of 2026, silver didn't just drift up. It rocketed after an already massive rally, fueled by speculative momentum, tight physical availability, and aggressive retail demand for bars, coins, and physically backed products. Now, some analysts say the fundamental value is far lower than the current price, implying a sharp correction risk. And that is exactly why you need a plan, because if you're in this, you have to accept the truth. Silver can be right and still hurt you on the way to being right. So, what does a plan look like? First, you separate trading money from insurance money. Insurance money is the metal you hold because you're hedging a system. Trading money is the capital you risk because you think you can gain volatility. Most people confuse the two, and that confusion is what gets them shaken out. Second, you understand that the silver story isn't one story. It's three stories stacked on top of each other. Story 1, industrial demand. We covered that. Electronics, grid, vehicles, PV, and even the AI-driven hardware wave that increased demand for high-performance electronics. Story 2, monetary demand. When rates shift, when inflation expectations wobble, when trust gets noisy, money seeks a mirror. Gold gets the spotlight, but silver often gets the stampede because it feels cheaper. And that psychology matters. Story 3, structural supply constraints. If deficits persist year after year, the market can run out of shock absorbers. Some research points to multi-year deficits and cumulative shortfalls that build tightness over time. Now here's the third cliffhanger. When these three stories align, you don't just get higher prices, you get a change in behavior. People stop selling, they start hoarding. And hoarding is what breaks models. So let me ask you an engaging question, and I want you to answer in the comments. Do you think silver's move is mainly about industry or mainly about trust in money collapsing? Because your answer tells me how you see the next phase. Now let's address something that always pops up when silver gets spicy. They're manipulating it. Here's my take. Markets can be influenced, pushed, yanked, and gamed. But even the best games collapse when the underlying physical reality changes. You can paper over a shortage for a while. You can't paper over a missing molecule forever. If a manufacturer needs delivery, a spreadsheet doesn't weld a circuit. That said, I'm not going to pretend the system is a fair playground. It's not. But instead of getting lost in conspiracies, focus on what you can measure: supply flows, demand flows, and the behavior of participants. And behavior is screaming. You have retail demand surging for small bars and coins. You have physical markets showing signs of strain. You have volatility that looks like a market trying to find a new equilibrium. Now let's zoom out and talk about the dollar side without turning this into a politics show. When governments run persistent deficits and central banks try to manage outcomes with policy, the currency becomes a political instrument. And when a currency becomes an instrument, people look for anchors. Gold is the old anchor. Silver is the scrappy anchor that also happens to be used in the machines of the future. That's why even while gold has been making headlines near record levels, silver's percentage moves can dwarf gold's. And just for context, gold has been trading in the neighborhood of major record territory recently, which matters because it frames the ratio conversation and the broader precious metals bid. Now let's deal with the part nobody wants to admit. A move above $100 doesn't just change silver, it changes the narrative about everything else. It makes people ask, if silver can do this, what about copper? What about oil? What about food? What about rent? What about wages? And that's why you're going to see two competing messages fight for control of your mind. Message 1, this is a bubble, don't touch it. Message 2, this is the start of something bigger, don't be last. The truth is often both. Short term, you can get bubble-like behavior. Long term, you can also get genuine repairik if the system's baseline assumptions were wrong. So here's how I think about it. There are 3 phases when a market breaks out. Phase 1, disbelief. It can't happen. Phase 2, irritation. It's stupid. Phase 3, panic. I have to own it. Most people buy in phase 3. That's why phase 3 hurts. So if you're already holding silver, the question becomes, how do you avoid doing something emotional at the worst moment? You remember why you bought it. If your reason was, I think it'll go up next week, you're gambling. If your reason was, I want to hedge against policy, debt, and monetary dilution, then your timeline is longer than a headline. And now I'm going to do something the hype channels won't do. I'm going to talk about what could go wrong for the bull case, because you deserve that. First, if the rally is driven by speculative leverage, a sharp liquidation can cause violent drops. That doesn't mean the story ends, but it can bruise you. Second, if policy responses tighten financial conditions unexpectedly, risk assets can wobble, and silver can get dragged with them in the short term. Third, if industrial users successfully thrift silver usage or redesign components, demand growth can slow at the margin. But here's the counterpoint. Even with thrifting, demand can still grow because the base is expanding. Think about electronics demand being supported by new waves like AI-related hardware, more devices, more data centers, more grid upgrades. So the question isn't can demand fall, it's can supply catch up fast enough to matter. And that's a tall order in a market where much of supply is tied to mining other metals. Now we're going to hit the part of the script that keeps retention high, the what happens next map. I see 3 near-term scenarios. Scenario A, the clean break. Silver holds above $100, consolidates, and then climbs toward the next magnet level. That's the bullish dream, and it happens when physical buyers keep absorbing dips. Scenario B, the shakeout. Silver spikes, drops hard, and then climbs again. That's the classic silver move. It punishes leverage, it punishes impatience, and it rewards anyone who planned ahead. Scenario C, the sideways torture. Silver chops between levels long enough to bore everyone, and then it launches when nobody is watching. Which one is most likely? If you force me to pick, I'd say silver loves scenario B or C because it loves to make believers suffer. But regardless of which scenario plays out, the structural factors don't vanish overnight. Now, let's talk about coins and premiums without naming any specific brand or channel. Whenever silver goes vertical, the retail market doesn't just get busy, it gets chaotic. Premiums expand, availability gets weird, product pages show out of stock, and people learn the difference between paper price and what it costs to actually get metal in your hand. That's not a conspiracy. It's logistics plus demand. And when that happens, the people who planned early feel calm and the people who waited feel angry. Here's a 4th cliffhanger. The next stage of the story is not about price on a screen. It's about who can source metal reliably when everyone decides they want it at the same time. Now, at this point, some of you are saying, John, okay, but I'm not rich. I can't buy Monster bars. Now, you don't need to. The game isn't how much you buy. The game is, do you own any exposure at all? And do you understand why? And that brings me to something important for community building. If you're successful, if you made a smart move, if you got disciplined, if you improved your financial life, drop your success story in the comments. Seriously, your story motivates someone else who's stuck, and it keeps this community grounded in reality. Now I want to pivot for a minute to the part that people skip but shouldn't. The psychology of $100. When a market hits a big round number, it becomes a stage. Influencers arrive, new money arrives, meme energy arrives. That increases volatility. So if you are watching this and you're feeling your heartbeat rise with every tick, that's your signal to slow down, because the market's job is to make you make mistakes. It makes you chase. It makes you panic. It makes you sell the bottom and buy the top. Your job is to act like a grown-up while the screen acts like a casino. Now, I'm going to do a quick mini lesson that most people ignore. The difference between nominal price and real price. A metal can go up in dollars because the metal is stronger or because the dollar is weaker. In a world where money supply expands and purchasing power erodes, hard assets can rise simply because the measuring stick is shrinking. That's why, when silver goes to $100, the right question isn't, did silver get expensive? The right question is, what did the dollar just confess? And the confession is this: confidence is fragile, but I also want to recreate the moment for you because moments like this teach you more than any textbook. When silver is grinding higher, people act calm. When silver is sprinting, people act strange. Your phone lights up, your group chats wake up and suddenly everyone has an opinion, even the friend who hasn't looked at a chart since 2021. I watched that exact shift happen as price started leaning on the high 90s, not just the number, but the speed. And that's when I knew this wasn't going to be a normal breakout. Because normal breakouts don't make entire supply chains nervous. Here's what most people miss. The $100 level doesn't only matter to investors. It matters to every institution that uses silver as an input, every dealer who has to restock inventory, and every exchange that has to think about margin and volatility. That's why when silver punches a headline number, the market often responds with a second punch: higher margin requirements, wider spreads, and more friction for anyone trying to chase. That friction is not a conspiracy. It's the market trying to slow down a stampede. And this is where paper and physical split paths. If you hold a paper product, you're exposed to price swings and financial plumbing. If you hold physical, you're exposed to premiums, availability, shipping delays, and the reality that a barcode is not the same as a bar. And you don't have to pick one camp to understand the lesson. In a stress event, everyone suddenly cares about what's deliverable. That's not theory. It's why vault inventories and exchange stocks get watched like a hawk during tight periods. Analysts have pointed to sustained drawdowns in vault inventories and rising holdings in certain products as signs the market has less slack than people assume. Translation: there's less cushion. And when there's less cushion, little changes can cause big moves. Now add solar to the mix. People throw the word solar around like it's a buzzword, but the numbers are not buzz. According to industry data, solar photovoltaics went from being a small slice of industrial silver demand to being a massive slice, about 11% in 2014 versus 29% in 2024. That's an enormous structural shift. So even if you believe some part of this rally is speculative, you still have a real-world demand engine that didn't exist at this scale 10 years ago. Now let's put a hard number on the deficit conversation, because this is where things get uncomfortable. Even with total silver demand reportedly around 1.16 billion ounces in 2024, the market still posted a sizable deficit. Some estimates have put the 2024 deficit near 148.9 million ounces, and the combined deficits from 2021 through 2024 have been estimated at roughly 678 million ounces, comparable to about 10 months of global mine supply. Read that again. Years of deficits don't just vanish because a chart gets overbought. Deficits eat inventory. Inventories are the shock absorber. When the absorber gets thin, price has to do the heavy lifting. Now let me hit you with another cliffhanger. If the market has been chewing through above ground buffers for several years, then the next shortage headline won't start with a price spike. It'll start with an empty shelf, and you're already seeing hints of that in the retail world. Look at what happened recently with official type silver products. The market got so volatile that a major government mint temporarily paused sales of certain collector silver items, then restarted after a repricing period with noticeably higher listed prices. Whatever you think about collector coins, that behavior matters because it reveals something basic. Even large institutions can get caught off guard by speed. And when big systems get surprised, little people get crushed if they're chasing without a plan. So, let's do a plan check right now. If you already have a position, your job is not to stare at the screen until you hallucinate signals. Your job is to define your rules. What do you add on? What do you hold through? And what do you never touch? If you don't have a position, your job is not to pick the perfect day. Your job is to start with a small step, then scale rationally. The market rewards participation with discipline more than it rewards brilliance with procrastination. Now, I'm going to bring this back to the one question that keeps showing up in my inbox. John, is it too late? And here's the honest answer. It's too late to buy at yesterday's price. It's not too late to build a strategy for tomorrow's reality. The people who win long-term don't get the best entries. They get the best behavior. They survive the shakeouts. They don't lever themselves into a forced sell. They don't let a single red candle rewrite their identity. Because yes, silver can drop $10 in a day and still be in a bull market. That's not a bug. That's the personality. Now, one more cliffhanger before we pivot. If this market is being fueled by both physical tightness and flow-driven products, then the next surprise won't be the move up. It'll be how fast the move down happens when profit-taking hits. And the only people who smile during that drop will be the people who prepared cash for it. Now, I'm going to pivot to the macro layer because this is what ties it together. When rates drop, when real yields get questioned, and when debt loads remain heavy, the demand for hard assets tends to rise. And that's not ideology, that's history. But what's new is the industrial side accelerating at the same time. Silver isn't just a fear trade anymore. It's also a growth input, which means you can have a weird world where the economy is shaky, and yet industrial demand stays sticky because electrification and infrastructure spending continue regardless. That's why some analysts have been calling this metal the crossroads metal. Part money, part machine. Now you might be wondering, if this is so obvious, why didn't everyone buy earlier? Because humans don't move on logic. Humans move on pain. They buy when the pain of missing out becomes larger than the pain of acting, and we're entering the zone where that pain flips. Now let's talk about what you should watch next week, next month, next quarter. Watch how silver behaves around the big round numbers. Does it dip and instantly get bought? That suggests strong underlying demand. Watch premiums in the physical market. If spot drops, but premiums stay high, that's telling you something. Watch inventory reports and delivery chatter, not because it's perfect, but because it reveals stress points. Watch the gold price and the ratio, not as prophecy, but as context. And watch the narrative. The narrative often shifts right before the next leg. Because when the crowd becomes convinced, the market looks for a way to hurt the crowd. Now, I want to do another community moment. If you've been grinding, building, learning, and you've had a win, maybe you paid off debt, maybe you started investing, maybe you learned discipline, share your success story in the comments. It keeps everyone motivated, and it turns this channel into a real community, not just a feed. Now, we're not done because we have to address the elephant in the room. What happens if the rally is unsustainable? Even if it is, unsustainable doesn't mean tomorrow. It means at some point. And markets can stay irrational longer than your patience can stay polite. The smarter approach is to assume volatility, manage position size, and avoid leverage that can wipe you out. And if you're tempted to lever up because you think $1 to $120 is free money, I want you to pause and remember the oldest market truth. The market punishes certainty. Now here's the final cliffhanger of this entire video. The $100 print is not the climax. The climax is what happens when everyday people realize the price is not the story. The trust is when trust in the measuring stick wobbles. Everything gets repriced. That doesn't mean the world ends. It means the rules of saving and investing change. And that's why holding some hard assets, learning the cycles, and staying disciplined is not paranoia. It's adulthood. One last thing to watch: lease rates and delivery chatter. When the cost to borrow metal jumps, it's a sign somebody needs silver now, not later. And when you start hearing more talk about location and settlement and availability, that's the market whispering that paper promises are being stress tested. If that whisper turns into a shout, the next leg won't wait for your paycheck timing. It will move when it moves. That's why patience and a plan beat panic, even in bull runs. So here's what I want you to do right now. Hit subscribe, check the bonus links in the description, and tell me in the comments what time you're watching and which side you're on. Industry demand or monetary demand. And remember, whether silver goes to $120 next or it smacks down first, the bigger lesson is the same. Prepare before the crowd, not after. And if you're still here, you're ahead of 90% of people. Thanks for watching. Take care of yourselves, take care of each other, and I'll see you in the next one. And as always, this video is for educational purposes only. I'm not a financial advisor, and nothing here is personalized financial advice. Do your own research and make decisions that fit your situation.